Question 8 says that the company is purchasing a new piece of equipment. The company requires a minimum rate of return of 12%. The new equipment is expected to generate cash sales of $100,000 per year, but is expected to generate $20,000 of cash expenses per year. The new equipment will cost $250,000. It has a 7-year useful life and $100,000 salvage value. The question is asking for the net present value of the investment. So again, to calculate net present value, the first thing you're looking for is the present value of all the future cash flow. So to find that, you want to just take all the future cash. So the most obvious thing that you see is that we are going to generate $100,000 of cash sales a year, but we're also going to generate $20,000 of cash expenses. So if you're receiving $100,000 in, but $20,000 is going back out, the amount of cash that you are keeping each year is $80,000. So I'm receiving $80,000 of cash each year for a period of 7 years. We have a minimum rate of return of 12%. We have a minimum rate of return of 12%. So the present value factor on that is going to be 4.564. So that's $365,120. Now, we are actually receiving another piece of income, another cash flow from this investment. It says that the equipment has a 7-year useful life and a $100,000 salvage value. Remember, a salvage value is basically a scrap, meaning when we're done with the equipment, we're going to be able to go out and sell it for $100,000. So when we sell it for $100,000 of cash, that's a one-time inflow. So we're looking at a present value of a single sum. So you want to use the single sum table. You're receiving the cash in year 7, so that's going to be your timeline, 12%. So that's going to give you a present value factor of 0.452. So that's going to give you $42,200. So that's the present value of all your future cash. And then you want to subtract from that the initial investment. So I'm going to come over here, take the two cash flows, add them together, and then I'm going to subtract out the initial investment of $250,000. So that's going to leave you with your net present value of $163,20. The next question says that suppose a new car wash facility required an investment of $100,000 and either has even cash flows of $50,000 per year for 5 years or the following. So it says to calculate the payback period in either case. So for payback period using even cash flow, it's really, really easy. Remember, you can just simply take the the investment divided by the annual cash inflow and get your payback period. So it's 2 years for A. For B, this is where we have to look at it in a little bit more detail. Remember, our goal is to get up to $100,000. So in year 1, I'm getting $30,000. In year 2, I get another $40,000. So basically, after 2 full years, I have $70,000. Okay? So I have $70,000 after 2 years. And I still need $30,000 from year 3. If you look into the third year is going to provide $50,000, but you don't need $50,000, you only need $30,000. So in year 3, you've got to do a calculation of how much you need of that year. So you need $30,000. The year is going to provide $50,000, assuming that the cash comes in equally throughout the year. That's going to leave you with 0.6. So your payback period is all of year 1, all of year 2, plus 0.6 of year 3. So it's 2.6 years. Question 10 says assume that the investment requires an initial outlay of $100,000. The life of the investment is 5 years with the following net income stream. Okay, so it says to calculate the accounting rate of return. Remember to calculate your accounting rate of return. Remember, you're going to take your average annual net income and divide it by the initial investment. So to come up with your average net income, then you just want to add all your years together, 30, 30, 40, 30, plus 50, and then divide that by the number of years. So 1, 2, 3, 4, 5 years. means that the average annual income is $36,000. And so then to get the ARR, you just want to take average income divided by initial cash outlay. So the accounting rate of return is 36%. Question 11 says the detailed market study revealed expected annual revenues of $300,000 for earphones. Equipment to produce is going to cost $320,000. After 5 years, the equipment can be sold for $40,000. In addition to the equipment, working capital is expected to increase by $40,000 because of the increase in inventory and receivable. The firm expects to recover that investment at the end. Annual cash expected. Typically, we don't really see this question asked very many times. Basically, your annuity would be receiving the $300,000 every year for a period of years, minus the $180,000 of expenses. So that's going to be what you would receive every year. Your rate on that is 3.605. Or I'm sorry, your factor on that. So that's $432,600. Then at termination, what it's saying is that initially, not only am I going to have to pay for this machine, I'm also going to have to put out another $40,000. But upon termination, I'm going to get that $40,000 back. Okay, so at termination, when the machine is done, so when we're done using the machine, what's going to happen is we're going to get our $40,000 of working capital back. Plus, we're going to be able to sell the equipment for another $40,000. So the present value of the termination is $80,000, and that's made up of the getting our working capital back. Okay, so the working capital at the end of the life plus the $40,000 salvage value, and those are two separate things. They just happen to be the same dollar figure, so they add up to $80,000. But it's going to be a one-time amount that you will receive in your when the equipment is done. At the end of the project's life is when you're actually going to receive all that at the end of year 5. So your present value factor is 0.567. That's going to give you $45,360. And then subtract out the initial cash outlay. Well, initially we're going to pay $320 for the machine, plus we're going to have to put out $40,000 to increase working capital. So there's where the $360 comes from. So it's going to leave you with $117,960. Question number 12 says that assume the hospital has the opportunity to invest $120,000 in a new machine that's going to produce net cash flows of $49,950 at the end of each year for the next 3 years. So we want to calculate internal rate of return. So the steps to calculate internal rate of return is the first thing you want to calculate is you want to find the present value factor. To find the present value factor, you want to take the initial investment and divide it by annual cash flow. So our initial investment is $120,000. Cash flow is $49,950. So that's going to give you a present value factor of 2.402. And then to find IRR, you're going to look factor up on table. So your factor is 2.402. So that's important. You also want to look at the timeline. So you're getting cash every year for 3 years. So you know that that's an annuity. So to figure out which table to look up, you're getting it every year, so it's an annuity, and it's timeline 3. So if I come down here to my annuity table, it's annuity table, timeline 3, and I'm looking for the 2.402. So I look across, look across, look across. Oh, I found it. Great. So once you find it, you look up, you see which column you're in, and you're in 12%. So that's your internal rate of return.